Welcome to Illuminati Silver. We tell you the truth about silver. Today is Monday, the 10th of January 2022, and we're producing our regular morning update providing prices, news and economic data. Today we see Goldman Sachs predict that the Fed may have to raise interest rates 4 times this year due to inflation and rising employment levels. Let's take a look. Welcome to Illuminati Silver. It's Monday, the 10th of January 2022 at 11:04 in the morning. The news today is worrying. Worrying for those who have mortgages, not necessarily for those who have savings. Worrying because Goldman Sachs now expects 4 Fed hikes in 2022. We'll take a look at that in a moment. Less worrying is the fact that JP Morgan believes that stocks can live happily alongside rising yields. But worrying again because Fed hike frenzy sends global yields surging despite growth angst. As we've said, good if you're a saver, bad if you're a borrower. Let's take a look. The Federal Reserve will likely raise interest rates 4 times this year and will start its balance sheet runoff process in July, if not earlier, according to Goldman Sachs Group. Rapid progress in the US labour market and hawkish signals in minutes from the Fed's December 14th, 15th Open Market Committee suggests faster normalisation. We are therefore pulling forward our runoff forecast from December to July, with risks tilted to the even earlier side, Hatzius says from Goldman Sachs. With inflation probably still far above target at that point, we no longer think that the start to runoff will substitute for a quarterly rate hike. We continue to see hikes in March, June and September, and have now added a hike in December. Well, these Fed hikes have sent global yields surging. Bond yields are soaring globally in line with treasuries as investors preparing for the first Federal Reserve interest rate hike of the pandemic era set aside concern the outbreak will slow their already fragile economies. Australia's bond market, already a focal point during last year's global spike in yields, is busy selling off, even as a spiralling Omicron outbreak pushes analysts to further trim forecasts for the nation's economic growth. The rout down under comes as traders bet the Reserve Bank of Australia will follow the Fed in raising rates. Despite expectations, inflation in the smaller economy will be well below the elevated US levels. Despite these rising yields, according to JP Morgan, stocks can withstand them. Equities should be able to withstand the recent increase in bond yields, which still has a way to go, according to JP Morgan Chase & Co. strategists. As long as yields are rising for the right reasons, including better growth, we believe that equities should be able to tolerate the move. The rise in real rates should not be hurting equity markets or economic activity, at least until they move into positive territory, or even as long as real rates are below the real growth potential. So we can see what the backdrop verbiage is going to be from major banks. As long as rates rise below either real rates or alternatively beyond growth potential, then everything is okay. Technically, from an economic point of view, they are right. The question is, will that happen? BBC News, a lot of it pretty domestic, more to do with unsafe cladding and energy. US news on the BBC, a little bit of bad news about New York apartment block fire, and also 2 US actors, comedians dying recently, Bob Saget and Sidney Poitier. Our thoughts to their families. Let's look at the economic data. The US dollar up slightly since Friday's close at 95.92, hovering around that 96 level. Energy prices marginally down 1 cent or 2 cents, so little changed. Equity markets, as we reported in our weekly update, the Dow, S&P and Nasdaq were all down last week and on Friday. Overnight, the Nikkei is down, but the Hang Seng Index is up as much as 1%, and Europe and UK marginally down, but all of them under 0.2% falls. So really little change, but with sentiment towards the downside. Economic indicator today, we have wholesale inventories revision for November. We're not expecting that to particularly move markets at all. And then tomorrow the NFIB Small Business Index. It'll be from Wednesday onwards we're going to expect significant moves. Looking at gold this morning, actually up $3. It's hit that 1800 level, though it did initially open down and then recovered again, spiked a little, fallen back slightly. Been as low as 1791 and as high as 1801, so we're not far off its high for the day. Silver, exactly the same. Initially fell, recovered again in the last hour or two, and we have silver up 9 cents at $22.49. Cryptocurrencies tending really to follow the markets. Overall, it's up nearly 1% on the day, but has fallen below that quite crucial 2 trillion market cap at 1.96 trillion. And Bitcoin is marginally down, but still standing above $41,000 at 41.6. But a lot of the other major cryptos are marginally up. That's it for now. Have a great day, everyone. We did promise a second video yesterday. We didn't really have time to produce it. There will be a second video either published later this afternoon or late tomorrow afternoon. So do watch out for it. If you haven't done so, please give us a thumbs up, subscribe, and press that bell sign so you're not reliant on us telling you that a video is coming out. You'll be automatically notified by YouTube. Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners. And finally, before we go, for those of you who missed our weekly update, we've produced links in the description box below and also in the comments section underlying this video.